Everyone starts a marathon from the same place, but not necessarily for the same reason. And the same is true when it comes to investing for income. Different folks choose income for different reasons. But whatever your goal may be, it's achievable with the help of the right advisor. It's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
Joining me right now is Sound Income Strategies founder and CEO David Scranton.
They've created a new type of inflation. And although markets have always been an emotional place, they seem to be even more of an emotional place these days.
Jeffrey Small, Market Watcher, is with me.
Stock market dynamic is getting ready to significantly change.
So let's bring in our co-host, Jeff Small, president of Arbor Financial Services, and also the brand ambassador for the Retirement Income Store. You've heard me explain the value of investing for income in many different ways right here on this show. But at the end of the day, there are really just three basic reasons why people decide to make that switch from investing for growth to investing for income. And we're going to examine those three things on today's show. Here are the three reasons. One, you're planning to retire in the next few years and know that you'll need income. Two, you may want to reduce your investment risk. Or three, you may want to increase your upside potential in the stock market. Now, sometimes these reasons actually overlap, and sometimes all three are achievable in one actively managed income-based portfolio. Now, of course, this all depends on your goals, your situation, and your risk tolerance. We'll talk about all this today and much more. Joining me, of course, will be my good friend and co-host, Jeff Small, and best-selling author and businessman, Robert Kiyosaki. And then later in the show, we'll talk to financial advisor Eric Lardner, one of the newest owners of a retirement income store, and he's located in Dallas, Texas. Well, we also have some news we want to share with all of you, our loyal audience. We're making some big changes to the show. We're moving the income generation to a new home on a new network. We're also changing up the format to a new and improved look. And we're sad to be leaving our Newsmax family after so many years. But we don't want you to miss out on any of our exclusive content while we figure out the future. So follow us on our YouTube channel, The Income Generation, where we'll continue to post the show as well as interviews with all of our favorite guests. You'll also be the first to know where and when our new and improved show will air after we make that decision. So subscribe to our YouTube channel, The Income Generation. All right. Now back to normal programming on today's show. Let's take a closer look at the first reason that many people decide they want to start investing for income. They're retiring soon and know that they're going to need income. Let's face it, for most of your life, you got your income from your job. But once you retire, the primary source of income, that source at least, goes away. And most people understand that as they get closer to retirement, they need to develop a plan for turning this pile of money that they saved during their working years into a new and dependable income source. Unfortunately, many people have been trained by the financial media and often by their own financial advisor or broker to believe that the most important factor in that plan is the amount of their lump sum investments. They've been taught that a successful income strategy hinges on having a nest egg large enough to last them throughout their entire retirement. Well, there are several problems with this line of thinking. The first being that the words large enough, really represent a subjective term. Many retirees who started with millions have managed to run out of income, while others who started with much less have enjoyed long, happy retirements with reliable income throughout. So while it's important to save as much as you can, the more important goal is to maximize the income generating potential of your savings, along with its potential for organic growth, something we'll talk about in just a bit on the show. But achieving that goal starts with understanding this formula, a formula which I share frequently here on the show. And that is, when investing, total return is a sum of both growth and income. Now, please keep that in mind as I share this example of how someone might improperly approach converting their savings to income when they've been trained to think that really the most important factor is the amount of the lump sum. So we're going to call him Bob. Bob's done a great job during the growth and accumulation stage of retirement planning. He now has $1 million in various types of savings. And after consulting with his advisor, Bob tells his friends, my plan is to retire in 5 years. Until then, I'll invest for growth and I'll get an average of 8%. And then shortly before retirement, I'll go ahead and switch to an income strategy and maybe be able to then start getting a 4% income flow. Remember, this is how many people are trained to think. So if Bob's plan works, he can grow his $1 million over the next few years, at which time he can generate at 4% $58,000 a year in retirement income. However, the strategy has one enormous flaw. It's based upon a huge unknown factor. There's a chance the market could cooperate, but there's also a chance that the market could turn against Bob and experience a major correction and a slow recovery, as it did in 2000 when the tech bubble burst, and again after 2007 when the financial crisis hit. And if that happened, Bob would no longer feel comfortable making the switch to investing for income at retirement. Why? Because his assets would be worth much less than $1 million. And in this case, if he didn't make that conversion, assuming that he had only a 1.5% dividend on his portfolio, his annual income would be only $16,000. $16,000 instead of $58,000. Because that 1.5% dividend is really the only known factor in his plan. And obviously there's a big difference between 16 and 58,000, which means that his plan carries an enormous risk. And right now I'd like to take the opportunity to welcome my good friend and co-host, Jeff Small, president of Arbor Financial Services, a retirement income store in Melbourne, Florida. And as you know, Jeff's also the author of the Amazon best-selling book, Turning Financial Planning Right Side Up. So Jeff, I've got to ask you, after our fishing trip last weekend, have you eaten all the mahi? Have you eaten all the wahoo left? Or are you like me, you're about to throw some in the freezer?
No, we didn't freeze anything. My kids love fish, Dave. We ate all of it.
I love it. Good for you. All right. I guess I have a smaller family, so it lasts longer. So Jeff, I hope you'll join me here in welcoming our guest, a really good friend of the income generation, best-selling author Robert Kiyosaki, who wrote the Rich Dad, Poor Dad series. He's also the founder of Rich Global, LLC, and the Rich Dad Company. Robert, thanks so much for being back with us here on the Income Generation.
As I said, thank you, because what you guys are doing is a great job. Much necessary.
Yeah. So you've written recently about GameStop and how average investors getting with GameStop is such a great thing. I have to tell you though, if you saw this coming, I'm a little perturbed at you that you didn't call us and clue us in, so maybe we could have had some GameStop in our portfolios.
Well, the big question today is GameStop versus silver or precious metals. And the difference between GameStop and silver, let's say, is GameStop is a fake asset and silver is a real asset. The other thing too is silver is a $200 billion, that's how much big business. And I think GameStop is probably 500,000, it's not much. It's 500 million maybe.
Right.
So it's easy to manipulate it. The silver market is manipulated also, but it's a different market than the stock market. Just a background, I've been in silver since 1964. When I first saw, when I was 16 years old, I saw the dime, US dime had copper tinge around it. That was Gresham's law, which meant that they were making fake silver. And so I started collecting silver, gold, and all that stuff, I bought my first gold coin in 72. I built a gold company in China in the 1990s, and the Chinese government took it, which and I'm not especially fond of the Chinese. And then I started a silver mine, and that's doing very well. So I've been in silver and gold and precious metals for a long time.
Well, silver, Robert, really is actually used in all the new TVs. People don't know this. There's an ounce of silver, unlike gold, which really doesn't have any true practical uses. Silver does have a use in business, like you said, and it's generating in industry a couple $100 billion a year. But we can't create interest earnings from silver. So what's generating all of this interest in hard assets today? Is it the short squeeze on silver that happened on the Reddit message boards where all of the investors came over to go long on GameStop and trump the hedge funds? So good for them, the tail wag the dog. But how do we generate interest earnings from gold and silver? How do we do that?
And Robert, I can't wait to hear your answer right after the commercial break here. So Robert, stay with us. We have a commercial break. We come back. We'll be asking Robert how to generate income from some of his favorite assets. We'll be back in a moment on the Income Generation. Welcome back to the Income Generation. I'm David Scranton, and I'm so happy to be here today with our good friend Jeff Small, and also an incredible friend of the Income Generation, Robert Kiyosaki. So Robert, right before the break, Jeff asked you the question about generating income. How do you generate income if you're going to be in silver? It's granted, it's a hard asset. It's not a fiat currency based asset, but still, if you're talking about silver, other commodities, maybe Bitcoin, I mean, can you really generate income from that if you're retired, if you're part of the income generation?
Well, it depends on how financially literate and experienced you are. I own a lot of silver company shares and gold company shares, and you can always, play the call and put option and short squeeze and all that. I think I wouldn't recommend it because that's a very sophisticated game. I make most of my money in real estate. Real estate is a game of debt and taxes. And after 2008, when interest rates dropped, I thought I died and went to heaven because the real estate market dropped also. Yeah. But the thing is that what the Rich Dad Company does is we recommend financial education. I'm studying constantly. That's why I'm saying you guys are doing a great job. I can't believe these Reddit guys and Robinhood guys are jumping in. They don't know the difference between speculation and gambling. Yeah. And if you're going to be a gambler, then you deserve to get what happens to you. Sure. Silver is a different market because the end user is a big company like Sony, sure, Tesla, battery companies. Silver is a very big market. You're not playing with a bunch of rookie amateur Reddit guys. That's the difference.
Yeah, and Jeff, that's what you were saying right before the break too. Televisions, things like that.
Yeah, I was saying that, and there was just a massive group of people that came in to buy GameStop and went long. But getting back to income, you mentioned something about real estate, Robert. So, interest rates are incredibly low. Real estate is incredibly fluid. There's a lack of supply and a huge demand in real estate right now. So, where do we see that market going, and what do you think is going to happen with real estate going forward? Are we going into a bust, or is the buyer in real estate today just too financially strong, just too solid? What do you see happening in real estate the next 5 to maybe 10 years?
No, there's too much fake money chasing real estate right now with interest rates so low. And the worst thing about it is commercial, which is office buildings and shopping centers are set to crash. And when that happens, the bond market's going to go as well as the stock market. So that's why I'm in gold and silver. I'm also in Bitcoin, but I'm also very excited about real estate because I've been in real estate for most of my life. I take real estate courses all the time. I do not gamble. But the biggest difference between real estate and paper assets like stocks, bonds, mutual funds, and ETF, real estate is not liquid, whereas paper assets, stocks, bonds, mutual funds are liquid. You make a mistake, you can get out. But you make a mistake with real estate, you're the skipper of the Titanic. And there's a lot of skippers of the Titanic out there right now who own office buildings and shopping centers. CMBS is collateralized mortgage-backed securities. Sure. They're going to be the biggest disaster going.
So Robert, final question then is that, most of our income generation viewers and listeners aren't really going to go out and buy a commercial property, but they might buy a rental property. They might buy a house or a couple of them. In a minute or so we have left, I mean, tell us, is the demand for those types of rentals strong enough right now where your average income generation member can use real estate in that way in bite-sized chunks in order to get cash flow?
I think I'm not in. I own 7,000 rental properties. I am out of the investment business for now because prices are too high and too many idiots are piling in. Now, does that mean I'm out of it? No, I'm waiting for the next crash. And that's what I was talking about. Commercial and the bond market and the stock market are set in precarious positions. I get sexually stimulated thinking about it, because I make more money in crashes. And so rather than chasing, at the top of the market, I would say to your viewers, take a real estate course. There's a lot of good books. There's a lot of online stuff like on YouTube and things like this. But real estate is illiquid. That's its biggest danger. You make a mistake, you're the skipper of the Titanic.
Yeah, and you've got to make sure that if you're going to rent it, you've got good credit-worthy tenants and long-term leases, and only then can you count on the cash flow. And you need a little bit of luck because black swan events like COVID do come around from time to time. So Robert, thanks so much for being back there with us. We really appreciate you being back on the show. Thank you. Did you know that the Retirement Income Store publishes its own newsletter? Each month, we share helpful information about the financial markets, research reports, and other resources to help you navigate the complexities of planning and saving for retirement. And we want to help make 2021 the year that you achieve and maintain your financial fitness. We're offering our loyal Income Generation viewers and listeners a complimentary 12-month trial subscription to the newsletter. So don't delay. This offer is only available for a limited period of time. Visit areyouFinanciallyFit.com to claim your free 1-year subscription. So let's take a moment to explore just a bit more why people might make the switch to income-based financial strategies. One of the major reasons is because you might want to lower your risk in retirement. And we talk a lot about risk reduction on this show, possibly more than just about any other topic. And the reason is because investing for income properly and doing it with the help of the right professional can help reduce your risk in a number of ways. Let's go back to the example I shared earlier. When our friend Bob plans to invest his savings in growth-oriented instruments, hoping to get 8% for the last 5 years of his working years, and then convert it to, let's say, things that maybe generate a 4% income stream. And again, this would net him $58,000 a year. But as I mentioned, the plan has one major flaw. Why? Because it requires investing in a big unknown. Whether or not the stock market will cooperate and deliver that 8% growth. And it could cooperate, just like Bob wants. However, it could also suffer a significant correction, possibly even on par with those that occurred starting in 2000 and 2007. And again, if that happened, Bob would likely feel extremely uncomfortable switching to income when he retired, because he'd want to hang on to his investments and try to recoup those losses. So in that case, suddenly that $58,000 in annual retirement income he was counting on would get reduced to $16,000 based upon the only known element in his plan, and that's that 1.5% dividend or so he might be getting, if he's lucky, in his growth-oriented plan. So, what's a lower risk alternative? Well, if Bob shifted to a 4% income generating strategy right now, instead of staying invested for growth for the next 5 years or so, he could actually count on getting $48,000 in interest in dividends at retirement. And he wouldn't have to worry about the possibility of the stock market taking another drop. Whether he was investing for income in bonds and bond-like instruments or in the stock market, either way, it's a known commodity. Even if the market did drop, he'd still be able to get $48,000 a year. Now, while the best case scenario in the income strategy, isn't quite as good as Bob's $58,000 number, his growth strategy, it does pretty much eliminate the risk of a worst case scenario. And again, that's just one example of how an income-based strategy can help older investors reduce the risk. Investing directly for income in years leading up to retirement can also help reduce your risk of spending down your principal due to things like the following. healthcare costs, inflationary pressures, or the need to satisfy RMDs. And that's true whether you have a more conservative strategy built entirely on bonds and bond-like instruments, or again, one with stock market exposure, because perhaps you're seeking more upside potential for portfolio growth. We'll be talking more about that right after the commercial break. Plus, I'll share one of the most common myths about investing for income. And of course, Jeff Small rejoins us. We'll be back right here on The Income Generation. I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Don't waste any more time. Visit myfreeretirementreview.com to find out if you have the right retirement strategy in place.
Welcome back to The Income Generation, and it's great to be here with all of our loyal followers. And as I mentioned at the beginning of the show, there are some big changes coming up in the next few weeks. We're updating and improving our format. We're also going to be airing The Income Generation on a new network. Meantime, subscribe to our YouTube channel, The Income Generation, so you can still get our exclusive content, but you'll also be the first to know when and where the new and improved show will air. But now let's talk about some common myths surrounding the concept of investing for income. One of the most well-known myths is that it means you need to sacrifice return. And the reality is that investing for income simply provides an alternative way to get return, an alternative to growth, one that I believe is much more practical for investors in or nearing retirement. Why? Because it prioritizes your income, and it also helps reduce your risk. But don't forget another reason investors do this, if they have higher risk tolerance levels, is that they're seeking the kind of upside growth potential that really certain income strategies can accentuate, the opposite of the myth. And that potential is not based on crossing your fingers and toes, hoping, for growth through capital gains. Rather, it's based upon strategic approach to reinvesting stock dividends, which can actually work in your favor when the market takes a dip. Think of it as dollar cost averaging on steroids. So let's go back to our good friend Bob, right? He hasn't retired yet, but he has intelligently abandoned his plan to invest for growth in the 5 years before retirement and went to investing for income now. As a result, he's already getting a reliable 4% return in the form of interest or dividends. But he doesn't even need the income yet because he's still working. So basically, he's using it to keep growing his savings, for reinvesting the interest and dividends to grow his money the organic way. And if his plan includes the right value-based, dividend-oriented stock strategy, then he has more additional growth potential through that reinvestment. And again, that's because should a market correction occur, he's now in a position to reinvest in more dividend-generating shares at a lower price and watch his income increase even faster as the market recovers. Again, think of it as dollar cost averaging on steroids. And that means more return in the form of income and growth. And they're going back in to grow his savings in the years just before retirement. That's the extra upside potential that attracts certain investors with the right risk tolerance when it comes to investing for income. Again, really just another way to dollar cost average, when dollar cost averaging really becomes more difficult later in life. Why? Because if you think about it, the contributions that you make in later years are smaller on a percentage basis compared to the amount of assets you've accumulated, assuming, of course, you've accumulated a decent amount of assets that are almost ready to retire. And as a result, dollar cost averaging has less of an impact than it did when you were younger. But if you can accentuate that dollar cost averaging through these reinvesting of dividends and buy shares even more rapidly, it can enhance your returns. Now, remember though that it does require a higher risk tolerance to invest in dividend stocks versus the universe of bonds and bond-like instruments, because sometimes companies do cut dividends or reduce dividends, as we saw in response to the COVID-19 pandemic. And that's why it's important to have an income specialist managing a dividend-oriented portfolio like this. Another common myth is that investing for dividends is easier than investing for momentum and growth. In reality, the exact opposite is true. The beauty with having a well-managed dividend portfolio is that you can be happy when the market's going strong because you know your 4 to 5% income return is secure. Plus, you can also be happy when the market drops because you now have the potential to increase this return through that dollar cost averaging effect. When retirement does arrive, you may decide you want to reduce your risk even further with a portfolio built more or entirely around interest generating investments in this universe I always call bonds and bond-like instruments. Or you may not. But with the right advisor, either way, you can easily make that transition and be sure you're going to be better off in retirement. We're going to take a short break, and when we come back, my co-host Jeff Small rejoins us to talk more about strategies for investing for income. Did you know that the Retirement Income Store publishes its own newsletter? Each month, we share helpful information about the financial markets, research reports, and other resources to help you navigate the complexities of planning and saving for retirement. And we want to help make 2021 the year that you achieve and maintain your financial fitness. We're offering our loyal Income Generation viewers and listeners a complimentary 12-month trial subscription to the newsletter. So don't delay. This offer is only available for a limited period of time. Visit areyoufinanciallyfit.com to claim your free 1-year subscription. Now it's time to bring back in our co-host, Jeff Small. So Jeff, that was the second try. I know you weren't able to be with us last time I interviewed Robert. That was the second try that I made to ask him about how average folks would generate income using his methodologies, and didn't get as straight of an answer as I had hoped. But then again, when you own 7,000 different rental properties like he does, I guess at the end of the day, you don't have to worry about income, right?
7,500 rental properties. I don't think he has to worry about income, but he has a penchant for hard assets now because of what's happening with the explosion in debt and what's happening at these market cycle peaks in real estate and in the markets themselves, the stock markets themselves. So, but the question is, his nature was to buy real estate for income or to buy investments that create income, Dave. That's really was his foundation and all of his philosophies. And of course, as he always says, if it was easy, everybody would do it. And so that's kind of where we are today, especially when it comes to investing for income.
Yeah. Well, it's interesting. You could say that about anything. You could say that about starting a business. You could say that about buying rental property and keeping it managed. And like you said, you can say that about whether you're talking about the universe of bonds and bond-like instruments, or you're talking about a value-based stock approach. Either way, these are things that people often need help with.
They need a lot of help because as a layperson, if you're trained to do something occupationally and you don't have the knowledge or the specialized knowledge to learn to excel in these areas, an investor can get hurt. And Robert brought up a good point. Real estate's so liquid, you've got to be very careful when you purchase it. The markets are risky. Folks have to look for that happy medium.
Yeah. It's interesting because I do think eventually what he's saying is true. In some way, shape, or form, all this fiat currency, all this cheap money around the world has to come back to haunt us. But these things can go, these bubbles can go longer than you've ever thought. And when you've got all the printing presses around the world working toward it, is it really gonna crash in the next 3 to 5 years or not? I tell clients that it's probably, clients that are my age or older, it's probably not going to come crashing down in our lifetime because of all these countries' ability to keep the presses going.
I completely agree with you, Dave. I don't think we're going to see another historic market correction. But, contrary to what Robert was saying, the real estate buyer today has never been stronger in any part of our economic history than they are now. And so that trend is going to continue, especially when the flow of money is so free-flowing with rates being so low.
The buyer has been feeling stronger. The only downside to that is, all the predatory lending is gone. It really hasn't come back. So there's some credit-worthy people that have a tough time getting the debt they need to buy a property. And also with the prices getting run up, some people are getting priced out of it. So So maybe those two balance each other out when it comes to supply and demand in properties?
Perhaps they will, perhaps they won't, Dave. But there's a big move into hard assets right now because the markets are too high. People are diversifying. What's a hard asset? Metals, real estate, things that are tangible that you can physically own, as opposed to having them on paper, having paper worth through the markets and investments and things of that nature.
Great. And maybe that's a great point to bring up with our next guest coming up in just a moment, where he's going to be sharing a few thoughts on organic portfolio growth. And that's Texas-based financial advisor Eric Lardner. He'll be here to give his perspective, so you don't want to miss it. Stay with us. We'll be back in a moment right here on The Income Generation. The Income Generation is now available on YouTube. Subscribe to The Income Generation so that you never miss a show. You can watch all your favorite episodes now in one place, as well as catch up with your favorite financial guests. Subscribe now to the Income Generation channel on YouTube. Welcome back to The Income Generation. It's great to be with you here today, talking about one of my favorite topics, and that's organic portfolio growth. Actually, I call it growing your money the old-fashioned way. And one thing I want to stress about this idea of growing your money the old-fashioned way is that it's not limited to dividends. You see, an actively managed portfolio of bonds and bond-like instruments can also offer a significant amount of growth potential through the strategic reinvestment of your interest and dividend income. And that can work especially well in the years leading up to retirement, when you still have income from your job and don't need your retirement income quite yet. You don't have quite as much upside potential for growth as you would in a high dividend stock portfolio. However, you do have less risk. You also have the security of knowing that your principal is better protected against market volatility. It's also contractually guaranteed to be paid back to you once your bond or bond-like instrument matures, provided, of course, there's no default. And even after retirement, many investors are able to continue growing their portfolio organically this way. Why? Because oftentimes, if they're fortunate, other income sources such as pensions, Social Security, or part-time work might just make it possible to reinvest some or all of these investment returns. So here's the bottom line. Regardless of your risk tolerance level, investing for income can be a strategy that makes income a renewable resource. The idea behind it isn't to grow a big pile of money that you can draw from throughout retirement to meet your income needs. The idea is to have a strategy that helps protect your savings and consistently generates and regenerates reliable income. That's income that you can use if you need it, or that you can reinvest to grow your portfolio organically, the old-fashioned way. Now it's time to bring back in my co-host, Jeff Small, as well as a brand new friend of the Income Generation, Eric Lardner, founder and president of Abundant Wealth Management, the newest retirement income store located in Dallas, Texas. Eric has more than 20 years experience helping clients. Eric, thanks so much for being part of our show here and being a new friend to the Income Generation.
Thank you. It's a pleasure to be here.
In your experience, what is the most common reason that your clients express interest in this concept of investing for income?
Well, the first thing I want to say is anyone within 10 years of retirement or in retirement needs to be considering investing for income. Most people, as they age, they know in the back of their mind that they need to de-risk their portfolio. The question they have is, how exactly do they do that? We use a pretty simple formula to explain how it works. TR equals I plus G. TR being total return, I being income, and G being growth. And the income comes from dividends and interest, and that's the formula we focus on. Now, when people say that they want growth they want more growth from their portfolio, what they really mean is they want more return. they don't really care even if they know the difference between the G and the I, they don't really care where the return comes from. But once they learn that the I is safer and more consistent, they prefer the I.
So Eric, traditional methods of income creation, at least from the financial industry, has been to liquidate assets, which is about the silliest thing anybody could do to create income. It's the equivalent of a farmer selling its land when it needs to produce food. So, in Texas, I'm sure you can appreciate that metaphor. So what's the best example you can give metaphorically to clients to help them understand the difference? Because we know, you and I both know, and Dave knows, that income investing really is simple for people that are over 55. You go into a conservative mindset. So what's the best metaphor you can come up with in explaining that to a client?
Well, the simplest metaphor is chickens and eggs. During the accumulation phase of your life, that's the growth phase of your life. You want to accumulate as many chickens as possible. As you approach retirement and you're nearing the top of the mountain, the purpose of your money turns 180 degrees. So that's when you want to start focusing on income, which is the eggs that the chickens are producing. So you can get back down the mountain safely and not have to worry about running out of money in retirement.
So we just want to eat the eggs and not the chicken is what you're saying.
That's exactly right, yes.
Yeah. If you kill the chicken, you won't get any more eggs. So it's a great analogy. I love it. We need to take a commercial break, so please don't go away, Eric. In just a moment, we'll be back with more from Eric Lardner, specifically about other reasons why other clients in Dallas, Texas, love the concept of investing for income. So stay with us. We'll be right back with more right here on the Income Generation. Welcome back to the Income Generation. It's great to be here with you today to share the collective wisdom of my good friends, Jeff Small, and a brand new friend of the Income Generation, Eric Lardner, founder and president of Abundant Wealth Management, a retirement income store in Dallas, Texas. So Eric, tell us, what are some of the misconceptions that you see your prospective clients, people that you meet with day after day, that they might have about the concept of investing for income?
Well, I think the biggest misconception or misunderstanding is not realizing that there's a problem to be solved. And there's several reasons for that. I think understanding sequence of return risk is important. To use a real world example, the period of time from 2000 to 2013, there was zero growth on the S&P 500. Now, if you had retired in 2000 and you were withdrawing money from your savings for 13 years with zero growth on your money, that probably would have created a problem. So we want to understand sequence of return risk. Timing is important, particularly as we get older. We want to avoid sequence of return risk. The other is understanding accumulation versus distribution. Accumulation being the growth phase, distribution being the income phase in retirement, which we talked about earlier. And this is really the core principle behind moving from growth to income. And last but not least, I would say that a lot of people think most financial advisors are pretty much the same. That's simply not true. If you needed knee surgery, for example, you would not go to a podiatrist, right? So if you need to be investing for income, you need to go to a specialist, and that's what we do. Is we specialize in income for our clients.
So Eric, with the market at all-time peaks, and we're at the all-time peaks of peaks, are you finding that members of the income generation or folks over 55 are embracing the income story and the income model more than, let's say, they were 10 years ago?
Oh, most definitely. However, investing for income is still a niche in the industry. There's not a lot of specialists out there doing it. If I could share a personal story with you about why I became a financial advisor in the first place. My father actually retired relatively early, and he always handled all the investing and all the finances. However, one day he just laid down for a nap and didn't wake up. And it didn't take me very long to realize that my mother's situation needed to shift and focus more on income so that she could maintain her lifestyle and not have to worry about cutting back on anything or running out of money in her lifetime. So that's where I started in the business, and it's given me purpose, great meaning, and it's been very rewarding helping clients.
Well, you nailed it, Eric, because most folks, when you ask them how to create income, even if they have an existing financial advisor, have no idea how to create income. And so the definition of a perfect retirement is having more income than you need. But what are the ways that we create income today? If somebody comes into your office, how do you tell them how to create income? What are the options to create income today that we have?
Well, the traditional way that people have been doing it is just reallocating from perhaps stock funds to bond funds, which isn't a very ideal way to do it. We have a list of alternative income producing investments that we can select from depending on the risk tolerance of the client. Income generating investments by their very nature are less risky anyway. So we want to stay away from risk in retirement. So we focus on, alternative income generating investments for our clients.
So, and when you say alternative, of course, you don't mean things that are brand new, that are newfangled, that make some big investment bank millions of dollars. You're talking about, in some ways, a lot of these things are really just going back to basics with investments, kind of going back in time. And in the spirit of that, final question I've got to ask you, the flag that you have behind you, tell us the significance of that flag.
The significance of the flag, well, we're all Americans. I celebrate America. The flag behind me happens to be a Revolutionary War flag. And, it just takes me back to, why this country was founded and what we all believe in. And I think for me, it's a very powerful message.
Yeah, unfortunately, some politicians today have forgotten about all that. So good for you, Eric, and God bless. Thanks for being on the show. And you stay with us. We have more coming up as we wrap up and summarize the most important things you need to know about investing for income. We'll be right back right here on The Income Generation. Welcome back to The Income Generation. As I mentioned twice earlier in the show, we're making some exciting changes to The Income Generation, including updating and improving our format. We're also going to be airing The Income Generation on a new network. So subscribe to our YouTube channel, The Income Generation, so you can still get our exclusive content. In addition, you'll be the first to know when and where the new and improved show will air. So let's recap today's show. At the beginning, I noted that although everyone starts a marathon from roughly the same place, not everyone has the same reason for participating. Some are there to win it. Others are there to just finish. And by the same token, people who make the switch to investing for income all have different motivations for doing so. But it boils down, in my experience, to three main reasons. Number one, they know they'll need retirement income soon. Number two, they want to help reduce their risk. Or number three, they want more upside potential. And as we've seen today, these objectives frequently overlap. And often they're achievable in the same actively managed portfolio. As we've also seen, a true income strategy can achieve these goals while exposing a whole bunch of common myths and misconceptions. Some of these myths include investing for income means sacrificing return, or investing for dividends is easier than investing for growth. And please, please, please remember, The ultimate beauty of an income strategy geared toward your situation and aligned with your risk tolerance is that it makes income a renewable resource, a resource that you can count on to meet all of your needs and goals throughout retirement. I'd like to thank my guests, Robert Kiyosaki and Eric Lardner, of course, as my good friend and co-host, Jeff Small, for joining me today right here on The Income Generation. I also want to thank you, our new and returning viewers. Remember, if you're close to or in retirement and you're concerned about your money, it's absolutely essential you stay informed and up to date. And right here is where you can do it on The Income Generation. I'm David Scranton, and we'll see you next week. The Income Generation is now available on YouTube. Subscribe to The Income Generation so that you never miss a show. You can watch all your favorite episodes now in one place, as well as catch up with your favorite financial guests. Subscribe now to the Income Generation channel on YouTube.